Knowing how to declare your taxes at the end of the year is a major component of financial literacy. However, tax rules are different in each country, and within each country they're different from region to region. So, it's impossible to learn the details in one document. However, the general concepts for taxation are very similar, and that is what we're going to look at here. Let's look at the basic principles of tax. Tax is money that's paid by citizens and companies to the government. Each country is different in how it taxes. Different regions tend to have different rules. In return for taxes, what does the government do? It builds infrastructure, that means roads, railways, airports, bridges, dams, power stations, electricity transmission, water and sewage transmission, etc. It provides security by having an army, navy, air force, police, fire service, ambulance, etc. It provides public services for infrastructure maintenance, public parks, transport, health for the elderly, etc. And it provides social security and pensions. And there are a bunch of other things that the governments do. In some countries, some of the above are provided by private companies but paid for by the government. The objective of this video is to familiarize you with the terminology used in discussing taxes, to summarize the general categories of earnings you may need to pay taxes on, and discuss some of the allowable costs that can be used to reduce how much tax you pay. We are here focused on taxation of individuals and only provide very general information. No matter how simple your financial circumstances, it would be very difficult to keep up with all the rules of taxation in your country unless you spend a lot of time keeping up. Please use your own professional tax advisors to guide and advise you on taxation, tax planning, and preparation of annual tax return where you live. You would end up spending too much time and too much effort if you try to do it all yourself, and you may get things wrong. To find a good tax advisor at a reasonable cost, start by asking the family, friends, and colleagues. There are two principal categories of taxes we pay. There are direct taxes and indirect taxes. Direct taxes are paid on money earned from employment, interest, dividend, etc., rental income, unemployment payment, and transactions. Sometimes when you buy a house, car, shares, or bonds, you have to pay some taxes. Then on wealth, which is the total of cash, property, savings, art, jewelry that someone holds. This applies if wealth is taxed in your country. And there is taxation of inheritance, which is the money or assets inherited from parents or relatives. And this is collected by the government if there is inheritance tax in your country. Indirect taxes are paid through buying goods or services. These are often called VAT, sales tax, etc. And you can sometimes find indirect taxes on products we buy where some tax has been collected sometime before we buy them. Depending on the country you live in, tax is usually payable on money earned, which can be from employment, where you work for a company, your employer pays you a salary, but takes some taxes away and pays the government. You could earn interest on savings, on the cash you put in a deposit account, dividends you get on shares you own, or you get an interest payment on bonds, etc. Then there's investment income. Some people make investments that pay them back an income over a period of several years. You could buy and rent a house or simply invest in shares. Then there's sale of investments. When an investment, say house, car, shares, bonds, etc., is sold, any profit made is often taxable. How much it's taxed depends on the country you live in. Then there's products and services. People who sell products or services receive money for what they provide. and they're usually taxed on what they earn. Then there are deemed benefits. If someone lets you live in a house for free, the value of the benefit you receive may be taxable. You don't pay any money, but you're saving money, so you're taxed on the money that you save. There's another category of taxes called taxes on transactions. In most countries, transaction tax is paid as part of purchase and sale of property. This is often called a stamp tax or property tax. When you're buying and selling securities, there's often something called a stamp duty or something like that. And then on sale of certain investments, there's often some kind of a duty or tax that you need to pay. This is just a one-off. And there's withholding tax. Sometimes when you hold shares of foreign countries, or even in your country, some of the dividend that's paid for you is deducted and paid to the government of the company where it's located. So if you're French and you buy shares in Germany, when the German company pays you a dividend, some of that dividend could be paid to the German government. Some or all withholding tax paid can usually be subtracted from your end-of-year taxes. All is country-specific, so this is not always the case. There are indirect taxes that are collected by public service and utility providers. These providers often charge some form of tax or VAT on the periodic bills they send. Again, all these taxes are country-specific. Some such bills are listed below. Electricity bills, water and sewage bills, gas bills, telephone bills, internet bills, public service broadcasters like a television license, road tax, which is a compulsory annual tax like a registration fee, and then road use tax, which is a compulsory annual tax to take the car on public motorways. Again, some of these work in some countries and not others. Usually, taxes paid in the above categories would not directly appear on your tax return, but they're collected as indirect taxes. Now we come on to wealth tax. Some countries charge a tax on the total net worth of a person. Wealth tax can lead to very large tax bills for the very wealthy people. By net worth, what one means is the value of everything they own, even paintings and jewelry and gold coins or family ornaments, but usually subtracting any debt they may have. Governments introducing wealth tax usually try to only target the wealthiest individuals. Many countries that have imposed wealth tax have seen the wealthy individuals leave the country. In the past decades, there's been a gradual move away from wealth tax across many countries, as it's been seen to lead to reduced entrepreneurship and investments. You need to know if you're subject to wealth tax where you live, understand how it's calculated, how much it adds to your tax bill, and what options you have to manage it. Please discuss your circumstances and options with your professional tax advisor. Inheritance tax is a very big deal. It is what the children or relatives who inherit assets or money have to pay to the government. Inheritance tax is debated in all countries because many people believe that inheritance tax should not exist. If somebody's parents have worked all their lives and paid taxes and earned money and accumulated the money, why should their children pay an inheritance tax on the money that's already taxed? So this is subject of a lot of controversy. Inheritance tax is a valuable source of revenue for governments, but its existence can substantially affect the structure of the society. When a large ancestral family property is inherited, if the inheritors don't have enough free cash, they may have to sell it to pay the taxes. If they use their existing assets to pay the taxes, they would need to find ways of generating income from the property. Either way, their lives will be dramatically affected. There are countries around the world that do not charge inheritance tax. If you live in a country that charges inheritance tax, you need to understand how it works, if it can affect you, and if you need to plan for it. Please discuss your circumstances and options with your professional tax advisor. VAT and sales tax are two of the methods governments use to charge indirect taxes on sales of products and services. Around 175 countries use VAT, and some 17 or more countries use sales tax. A sales tax is a tax charge when the final customer buys a product. A VAT, which stands for value added tax, is a progressive tax which is charged as value is added to a product at different stages from production to manufacture and sales. Although only companies with turnovers, which means sales, above a certain amount need to collect and pay VAT, individuals only pay VAT when they buy products and services. Governments often propose changes to these taxes in their financial budgets, so it's necessary for you to understand how they work and what they are. You would not need to worry about VAT and sales tax when dealing with your personal tax matters. If you set up a company, they would become much more important. When preparing your annual tax return, certain expenses can be subtracted from your annual income before you calculate how much tax you owe. The expenses that you're allowed to subtract from your income are usually called deductible expenses. They often include some of the following. Personal allowance. This is the amount the government allows you to earn tax-free. This may or may not exist in your country. Then there's child allowance, which is the amount the government allows you to earn tax-free per child. There are child care and dependent care expenses. These are the costs of looking after your children or someone who is dependent on you. There are allowable work expenses like travel and the use of home office, especially for self-employed people. Mortgage interest is often tax deductible. Certain debt interest and sometimes credit card interest are deductible. Some home improvements or renovation costs, including new renewable energy installations, are tax deductible. There are allowable medical insurance or general insurance costs that could be deductible. School and education expenses are sometimes deductible entirely or up to a certain percentage. Subscriptions to professional societies, these are memberships, etc., in relation to your employment, that are often deductible. Then there are charitable donations, money that you pay charities, that can be deducted. Mortgage, other debt, or credit card balance, these are the amounts that you owe, can also be used to reduce your total wealth if in the country you live in, wealth tax is charged. Car depreciation can also be used to reduce the value of your vehicle for wealth tax. Usually, the value of the car gets reduced every year in accordance with certain metrics that the government and tax authority provide. This list is unlikely to be complete for all countries, so please ask your personal tax advisor for advice on the allowable expenses that you may be able to benefit from. Let's now look at tax credit. Some tax benefits are offered as a reduction to your income before tax is calculated. We looked at some examples on the previous page. Some tax benefits are subtracted from the tax payable. These are called tax credit. When preparing your annual tax return, tax credit of the following general types may be relevant to you. Tax already collected from your monthly salary by your employer. Tax which is already being withheld, meaning taken away, from payments on shares, bonds, ETFs, and other securities. Tax withheld from interest payments by banks or others. Child tax credit, an amount that your government may offer you for each child. Then there's child and dependent care credits that depend on each country. There are renewable energy installation tax credits, which are limited up to a certain amount and are there to incentivize people to use renewable energy. Then there's electric vehicle tax credit, which is again a government incentive to encourage buying EVs. Please ask your personal tax advisor for advice on the tax credits that you may be able to benefit from. Now we come to planning your tax return. Tax return is the paper or electronic document that you prepare at the end of the year to send to the government so that they can work out how much tax you owe. It is helpful to have a system for preparing your tax return at the end of the year. The following is one possible solution that works for many people. You create a new folder for annual tax with 10 or more separate tabs. You label tabs with income, deductible expense, and tax credit categories that apply to you. You also label tabs with wealth tax categories that apply to you if you live in a country that charges wealth tax. Through the fiscal year, by that I mean tax year, you fill in each tab with the relevant documents. For anything to do with tax, it's best to use your professional tax advisor. Tax regulations change all the time. Professionals can keep up with the latest changes because it's part of their job. Private individuals may find this difficult or time-consuming. Professional planning saves taxes.